Well, this quarter we celebrated a huge milestone in our 20-year anniversary. Myself and Erica Gordon and Russ Mackay, we were all there together back in June of 1999 as part of a founding team that founded CWB McLean & Partners. And this quarter, to celebrate our 20-year anniversary, we launched a unique video series where we invited clients and team members to come out and share some of their lifelong learnings and be part of this amazing video series. And so it's come together really well, and I would encourage all of you, if you haven't had a chance, to check out some of these videos on our website. And with that, I also want to thank all of our clients and team members and everybody at CWB that has supported us over the last 20 years. Your relationship, your trust is super appreciated and valued, and we look forward to 20 more years. Thank you. Well, within our culture, we really encourage everyone here to embrace the new. And by embracing the new, we mean continuous improvement. And so we're always looking at ways to improve our client experience. And so this quarter, we're working on a couple of enhancements to our Pure Portal website, where we plan to change the layout to just improve the way things look visually for our clients. And in addition to that, we're going to be adding some performance calculations and some performance information to the website as well over the next couple of months. So stay tuned, and we will keep you posted when we go live with those improvements.
It's without question, I think, the biggest surprise of 2019 was the pivot by the US Federal Reserve. When we think back to just 6 months ago, the US Fed was actually raising rates, much to the chagrin and surprise of many. Since then, they have turned decidedly dovish and now are in the process of potentially cutting rates, again surprising many investors. What surprises us is how many investors are surprised by this. The chart you were looking at shows the interest rate movements by the Fed in red versus what's expected by the market and investors in black. And what's clear to us and undeniable is that since 2001, analysts and investors alike have had no insight or accuracy in predicting what the Fed will do. The Fed will do what it will do, but we believe our best course of action is to stay disciplined to our process and philosophy and take advantage of those opportunities presented by those who think they can. We view the US-China trade war as a battle for the top dog. But ultimately, after all the bravado and posturing is done, we believe there will be resolution, and this is our base case. We've discussed at length about investing with the unknown and the unknowable. And this is another perfect example of dealing with that. So we have companies that are dealing with the short-term pain of a trade war versus the long-term gain of doing very, very well once the trade war is resolved. So, have we made changes in the portfolio? When we look at the constantly evolving risk reward, we have made some changes to free up some cash, which gives us the optionality to take advantage of the negative sentiment which prevails when investors are dealt with and are dealing with the uncertainty of a trade war, which is very difficult to quantify.
Normally we don't pay much attention to short-term performance, but given that trade war has been an important driver of market returns and volatility so far, we have been paying attention. Our portfolio did outperform in the first quarter of the year, But in May, when the trade rhetoric worsened, when negotiations stalled, the portfolio started to underperform. But thankfully, in June and July, we're able to recover from this underperformance. Now, our portfolio is skewed more towards the value, the cyclical stocks right now, and we believe these are undervalued as opposed to the low volatility, quality compounder stocks, which we believe are overvalued. And our process drives us to own more of these. And what's interesting is that as the trade war rhetoric worsens, people don't want to own any of these value stocks, and they only want to own these quality compounder stocks where they believe nothing bad will happen, and the prices of these value stocks reflect that nothing good will happen. So when this rhetoric worsens, we found that this valuation gap diverges, and when the rhetoric improves, we've seen this valuation gap closes. So our portfolio is skewed, as I was mentioning, towards these stocks more. And we believe that this divergence, this valuation gap, which is at historic levels, is simply unsustainable. And therefore, I think going over time, our portfolio is well positioned to do well and to outperform going well into the future. So in May, we trimmed our holdings of Galaxy Entertainment Group. They're an operator of hotels and casinos in Macau. And at the time, the stock price was around 54 Hong Kong dollars. And this was when trade negotiations had just stalled. So we felt that at that price, the risk-reward skew was perhaps uncertain and potentially not even in our favor. And hence we decided to trim some of our holdings there. Now, to explain the rationale there, as the trade war becomes worse, as economic uncertainty worsens, we're worried that the Chinese consumer might dial back their spending on travel and entertainment. And obviously, Galaxy being a destination, we felt that tourist arrivals to Galaxy's properties may fall. So as I was mentioning, we sold some there. And then we were able to redeploy that cash into Infineon Technologies, one of our other smaller holdings, when that stock dropped from 20 euros to 14 euros in the span of just over a month. And it dropped primarily on the fear of economic uncertainty due to the trade war, but then also because it announced a major acquisition. Now, at 14 euros, we felt that the risk reward was completely favorable, was in our direction. And then that a negative outcome of the trade war was already priced into this. Now, we like the company, we like the management. We felt that the long-term thesis is solid, it's intact. And so we decided to buy some there. So this is an example of how we switched from Galaxy into Infineon. And we do a number of these switches over time in the portfolio. And what we feel is this improves the risk reward skew within the portfolio and improves its positioning relative to the market.
Not really. While there may be pockets of exuberance in the market, we are still finding good value and opportunities across the board. For example, Johnson & Johnson trades at less than 15 times forward earnings, which, given its business, we find excessively cheap, as well as, yes, we know there's some hair on the stock, there's some litigation issues. However, we feel comfortable, given the business, that the valuation is compelling. Having said that, when we buy stuff such as Johnson & Johnson, what it does is that, given our stocks are out of favor, portfolio suffers for the time being. However, we are okay with that, and we are comfortable owning good businesses because we believe over a period of time we'll be rewarded. Yes, the one that would come to mind is divergence in valuation between financial sector and the tech sector. And a specific example using two of our biggest holdings, one in tech and one in financial sector, is Microsoft versus Wells Fargo. If you look at the earnings for both companies over the last 10 years, and there's been ebb and flow in terms of one grows faster for a period of time and the other grows faster for a different period of time, but the earnings are pretty similar. And yet, the valuation discount between a Microsoft and Wells Fargo seems excessive to me. I'm not saying that Microsoft is a bad business or we don't like the valuation of Microsoft for what it's doing. All I'm saying is that the divergence between the two is excessive. When we bought Microsoft 4 years ago, it's strange that Microsoft was trading similar to where Wells Fargo is trading today, because nobody believed they would survive in the cloud, the world of a new or the new cloud or digital world and could grow as fast as they're growing. But lo and behold, today, it's a favorite stock for everybody. And what we are hoping and we see is that Wells Fargo could be the next Microsoft.
The most important development in Canada this quarter was the latest bank reports. Last year, we highlighted the significant new accounting rule IFRS 9, which regulates how the banks have to report their loan losses. We said that the result of this change would be more volatile bank earnings, which may make forecasting them a little bit more difficult. We also said that the result of this may be faster recognition of loan losses when the economy slows down and potentially lower bank valuation as a result of higher earnings volatility. A year and a half later, the result of this change is that in the past 2 quarters, 4 out of the 6 largest banks missed analyst earnings expectations, something that has not happened since 2010. Expecting this, we maintained an overall underweight in the large Canadian banks. In TD, Scotiabank, and CIBC, our weight is roughly in line with the TSX, and in BMO, our weight is roughly twice the TSX. We have no holdings in RBC, but we hold 5% in Equitable Bank, which is not in the benchmark. We believe it does. The Canadian banks are not only about real estate and mortgages, they are highly diversified financial institutions. Lately, the Canadian economy has been rebounding. One of the indicators that we look at is freight activity, and the Canadian railroads have been very busy, also partly thanks to the implementation of the free trade agreement with Europe. As such, we do not believe that these high provisions will persist. Specifically to the question, housing markets in Toronto and Vancouver have been stabilizing lately, and industry-wide mortgage balances increased over the last 2 months. Lately, also there are discussions in Alberta about ending the oil curtailment regime, and importantly, unemployment rate is still very low. We believe that just as provisions increase fast, if our view on the economy is correct, these provisions will decline just as equally fast. As such, we recently increased our weight in the banks. We recently increased our weight in TD from underweight to benchmark weight, and we are close to concluding our work on RBC and potentially adding it to the portfolio.
Well, I think whether the Bank of Canada cuts or not, I think that's the million-dollar question, and a lot of investors put in a significant amount of work to try and figure that out. The short answer is that the Bank of Canada will do what they will do. We talked previously about how difficult it is to try and figure out what central banks will do. They have different mandates, and certainly with the Bank of Canada, the mandate of 2% inflation is something that they've reached and therefore difficult to understand whether they will or they won't cut. So these macro uncertainties of trying to figure that out and where investors sort of fall lead us to find some micro opportunities, which we then can put our full force of a research behind to try and uncover. So I think that's where we will spend the vast majority of our time, is try to uncover those micro opportunities that have been brought about by these macro uncertainties. Unlike the situation where you're trying to figure out a low probability event of whether the Bank of Canada will cut or not, we think there's more value in looking at idiosyncratic situations where we can utilize and leverage our research process and philosophy to uncover great opportunities. I think one of the things that we've done very well, for example, recently, is using Sackett's work on a US utility called PCG to buy their bonds. And that's been, from a risk-reward perspective, much better in terms of highlighting what the value add in a fixed income portfolio, because buying those bonds has returned about 20% over the past, has returned about 20% year to date, while trying to figure out what the Bank of Canada will do is a much more difficult call to make. Continuing with the PCG example, that we talked about. It was Sackett, obviously, who uncovered PCG from an equity point of view. But as we started talking and understanding more about the utility and the opportunities that it provided, after all, this was a company that was going to go through a Chapter 11 proceeding, which doesn't always bode well in terms of, coming out the other side. But our research showed us that when we looked at the company, that actually it was in their best interest and the company's best interest to actually go through these proceedings, and the market was misinterpreting what that meant from a fixed income point of view. So not only did we use that from the equity perspective and have the equity in the US pool, but we were able to leverage that and actually buy the bonds in the diversified fixed income pool as well, to take advantage of what we thought was a great opportunity.